First topic today, guys. The Federal Reserve leaves rates unchanged. Here's what that means for your wallet. Last week, Jerome Powell and the Fed came out and said, pause, we are not going to be raising interest rates, and we're going to continue to have rates elevated higher for longer. This obviously has something that means on the surface, and then it has a little bit more long-lasting durational effects. So what did you guys take from the press conference? What are you looking at? What are you skeptical about? I got a couple things.
All I can say, it's about time.
Yes.
11 consecutive interest rate hikes since March of 2022. That is crazy. This is great. Like, it's just applause, right?
Yeah.
But hey, let's not get excited.
Yeah, I think there's a little bit of room for caution. I was looking at the graph that connected to the article. I'm like, man, that is one steep incline.
Just spiked up.
Massive steep incline.
Yep. And we got to remember the FOMC is going to meet
in December.
In December. So who knows what's going to happen there.
And that's what I wanted to basically come in and say, that right now it's not stopped. It's not done. It's just like, let's just wait and see how data comes in next time around that we meet in December. And I'm going to go out and say that I think they're going to go ahead and raise it up, that in December, because you saw how the market took it these last couple of days, that, it took it very positive. But if you've seen previous times where they do something like this, we get that market pickup, but only for it to come right back down once they, fully let us know their sentiment.
Yeah, it does have a whipsaw effect. It's kind of like the initial shock value or novelty of the decision makes the direction go in one direction because everyone's interpreting, this means something in one way or another. But then more data comes out, more of it kind of like the dust settles, and we go, okay, well, what does that actually mean? Because here's what's going to happen in 2 weeks from now. Their notes are going to come out.
Yeah,
and then the market's going to react to their notes coming out. Oh, what'd they actually say? How'd they come to this conclusion? But I mean, look, they're kind of already tipping their hand at the same way. They're saying higher for longer. So that means that even if they do stop here, or even if they have to do one more quarter point rate hike, either way, it's going to be here for a while. I don't think anyone in their right mind can be advocating that they're going to see a Fed funds cut in the first quarter, second quarter. There's no reason for it until there is a reason that shows up. I don't expect there's going to be one.
Yeah, it's like a suspenseful movie, No,
100%.
What's going to happen? We're just kind of biting our nails here.
And Patrick Bet-David said it best. Like, if they do bring interest rates down anytime soon, what do you guys think is going to happen to the market and those prices? Well, they're going to swarm right back up.
Go right back
the
up.
Market's going to get inundated with buyers again, and then we're back to the same problem that we've never been able to get off. So,
and I think this is part of what's confounding a lot of the people that I watch online and on YouTube, and we get some of these comments too. And it's like, hey, this is what happened last time. And like, I know that's what happened last time. But here's the thing: there are so many differences in what's happening now mechanically than what's worked in the past. Because what worked in the past isn't actually showing like it's going to work right now.
Nope.
Because if it were to work right now, and we're already 19 months into this, it would have already started to show up. Yeah. It's not showing up. Prices aren't correcting as fast as they should. Inflation is still in positive territory. It's not negative. So this argument of, in the past this happened, whether the past was the 70s or the past was the dot-com crash or the 08-09 collapse, this is not the same deck of cards.
Not at all.
And the outcome should not be compared to that, proportionate to the amount of variables and the types of variables that are impacting what we're seeing happen right now.
And then again, the federal funds rate is tied to credit cards, auto loans, student loans, or personal loans. So it doesn't necessarily directly affect the mortgage rates, although the Treasury is the one that more or less, gives you the closest thing to knowing if rates are up or down. But at the same time, the biggest thing that I get from here is that, consumers are using a lot more credit and they're still spending. So it looks to me, when are they going to hit that period of, hey, I'm done, no more credit. But I did see that, job reports came in a little bit lower than before. So maybe this is going to be that, that starting tip to where we start seeing spending go down. But I'm curious to see how Black Friday plays out.
Yeah, well, we'll see about all that good stuff. The good thing is right now, people who are actually saving their money, they're actually getting paid by the bank.
Yeah.
Right. I kind of did who's paying what, right? And I see this bank, UF Direct, offering a 5.5 APY, annual percentage yield, right?
Wow.
So they're actually paying you for storing your money at a bank account, which is not too bad, because you guys remember not even a year ago, they were paying 0.0 whatever, not even 1%. And here we are. Now they're paying 5.25%. So the way the banks look at it, hey, the more that we incentivize the consumer to save their money here at our bank, right? Then we can actually loan it out for more. Since we're already borrowing for the federal government at 5.25%, 5.5%. Now they look at it like, well, we might as well just go to the consumer.
Yeah, and it's an arbitrage play, right? It's always that way. It's how much they're going to borrow the money for, how much can they lend out for, and that spread between becomes margin of profit. And the APY, 5.5. I've never seen that as an adult.
Yeah, it's that.
It hasn't been the high in
not 5.5
decades, right?
I'm sorry, 5.25.
5.25. Okay, fine.
That's
5.25. I still haven't seen anything in the fives in my adulthood.
I've never seen anything in the fives in my whole adult life.
Oh, but wait.
Your
I
entire
missed
life.
it.
Yeah.
I missed it. Citizens Bank is offering 5.5 actually.
Okay,
APY,
wow.
while SoFi is offering a 4.6.
Yeah. And I mean, and then again, any of those that are actually outpacing real inflation in your life, I'm going to qualify that. Disclaimer, asterisk, check me in the comments, that are in your real life. The inflation in your real life, including your food, your rent, your clothing.
There it is, okay.
Any way that number is outpacing that, then that's a safe bet for people to put some money away for a secure period of time and then come back to it later with a little bit of gain.
Yeah. I know, like when my mom sold her house, we put it at her bank. It didn't make anything.
Right.
There's no interest. At least this way you could put it in there, make something, it's, and it was quite a bit of, I can't believe Mom. Good job. Two thumbs up. She saved quite a bit.
And I think that this kind of goes hand in hand with the debt conversation because we're talking about credit card balances in the U.S. Crossing the $1 trillion cumulative total for 1.02 trillion. But here's what's really gnarly about that, guys, is it was as low. I know it's a relative statement. As low as like 750 billion less than 2 years ago, or let's just say 2 years for the ease of conversation. Let's say 2 years ago it was 750 billion. Now it's $1 trillion, and in 2020. It was about 850 billion. So we have like really rapidly at the same clip that the Fed has increased rates. We are assuming more debt as consumers, and this will have to have a day of reckoning.
Yeah, we're almost like a government, I just continue.
We're just keep borrowing more and spending more.
Proportionately, we're actually better than the government.
Borrow more. Spend more.
I know they're at 133 trillion, right? But I mean, we're only at a measly 1 trillion.
Depends on the number you're talking about. Yes, but the rate at which they're accumulating it is way faster than us as consumers.
Yeah.
There is something interesting though I wanted to share with you guys is that when I looked at how much home equity there is left,
my God,
on average, like the national home equity, I think in this article they said there's 31.6 trillion worth of home equity. Now, this is according to Jacob Channel, senior economist at LendingTree. Yeah. So if all of that $1 trillion of consumer debt was paid off, there'd still be 30 trillion of equity left.
Yeah.
So here's the thing. I want to make sure I demonstrate to people when I talk about in this part of the show. We hear a lot about, home equity lines of credit at 12%, 14%. That's absolutely crazy. Well, in the same article, the average consumer's credit card adjustable rate for their credit is 20% or higher.
That's high.
So you're swapping a lower rate, yes, connected to your house. But again, if you have all this equity, you're making the house do some of the heavy lifting. I understand why people have their personal preferences that they don't want to do that. That's fine. Spend your cash. You can spend your savings. You can spend money from your investment account to pay off your personal credit debt. But for some people, the house is the answer to their current problem, depending on how big that problem is.
Yeah.
No, 100%. And to that point, I feel like, people not looking at their house as a solution is in a way hindering yourself because you have an asset there that can just continuously replenish itself as the values continue to go up. And in San Diego, values just continue to go up and up. But my thing is, to what point do homeowners need to get for them to say, oh, you know what, I'm actually going to tap into my equity that I have that I could have, been out of this, storm months ago, but now I'm going to go into it.
I think some of it has to come out with pain. And the other side is the opportunity. So where there's a pain point where maybe someone has, like we used in a previous example in a show, like $100,000 of consumer debt. Yeah. Okay, that's not a really good situation. If you have $400,000 of equity and $100,000 of consumer debt, now what you're saying is you're going to have only $300,000 of equity, but have your consumer debt paid off. Oh, but there's a HELOC payment. Correct. But that HELOC payment in Brian's example took their out-of-pocket expenses down to $700 from $2,000. They saved $1,300 monthly on their budget. Yeah. So that's a solution for somebody. Oh, well, but you've chipped into their equity. Okay, fine. Let's play that game. Let's say they sell their house in a year from now. Yeah. They still have $300,000. They have paid off all of their debt, and they have whatever payment they have left. If they're going to sell their house, then guess what? That line of credit gets paid off too, guys.
Wow, you did all that math in your head right there, huh, Andy?
Yeah, I did, because we talked about
beans.
I did because here's why, guys. Like we are going to run across these scenarios. There are people like catching on to the videos now, watching and commenting and having these exchanges with people, and they're very healthy. They're very good. And I understand where people are coming from. Not everyone lives in San Diego or California where we're talking about $400,000 of equity. I mean, recently someone just posted like, hey, I just bought a house and my payment's like $500 and it's going up to $530. Like, that's amazing. That's not here. Jeez. So we're talking about $400,000 of equity. You had an example earlier. Someone's got a house. Maybe the value is about $1.5 million. Yeah. They own about $1 million. That's still 65% LTV roughly on $1.5 million home. But that's where we're dealing with here. And people do have a solution. Even if you don't like it or you think it looks kind of ugly, for some people, if they're in enough pain, they're going to have to consider something.
That's what I was, and that's what I was saying last week, where it's like, well, you have to value which one's going to hurt more. You know, the value of you not paying your stuff or not being able to keep up, or, you know, taking that, you know, Band-Aid out right now, putting it on, slapping it on, and then in a year and a half, you could rip it off. And
just remember, when you're kind of consolidating everything to one, it kind of feels like this huge burden's off of you, because you don't have to worry about, dang, is that one on auto pay, or do I have to send a payment through this? It's like when you have multiple payments, like, I hate even going to the mail.
Yeah.
You know what I mean? Good thing is, I don't make any payments, so I don't have to worry about that. But
for those
who do, for those,
for those of you that have that problem, there's a solution. But I wanted to make another point. This is more of a technical point, guys. But look, if the Fed is pausing, and this is the pause, let's say there's no other rate cut. Let's play out that scenario. That means if you do get yourself in any sort of adjustable payment right now, then you're looking at that same payment or lower when they start lowering it. So anything that's connected to the prime rate that you secure now, whether it's an adjustable rate mortgage, it's a credit card, it's a line of credit, if it is tied to prime and that prime starts marching its way back down the stairs over the next 24, 36, 48 months, then that payment associated to that payment method is also going to decrease on the monthly.
Yeah, for sure.
Wow, that's a very creative and lucrative option that you can take if you're betting on saying, hey, rates are going to come down, which we all kind of know in the next 10 years, 5 years, they are going to come down. Slap a 5-1 arm on that and call it a day.
It's just a technical thing.
It makes perfect sense.
There's going to be a variety of opinions, I'm sure, but again, it's not for everybody. But in some scenarios, that might make sense to do now because your other option may not be as favorable. And so it's a risk that people are willing to take, just as much as it's a risk to be in a fixed position for 30 years too. That's a risk. People don't think it is. They go, oh, that's the best thing. Well, not in every scenario. Honestly, it isn't.
One of the approaches I'm taking right now when I speak to clients, they ask me for my professional opinion. Hey, what would you do? Would you buy this house and rent this one, or buy it and sell the one that I currently have? My response 99% of the time is, well, let's take a step back. What is your long-term goals looking like? You know, what is it that you want to do in the next 5-10 years? Then make the decision based off of how close that's going to get you to where you want to be. And then I give them my personal opinion. If it was for me, I would rent the house because I know rates are going to come down. You're going to have a cash cow here in San Diego. Later down the line, you can always refinance and then even get more on your rental. But if you want to take the route of cash out, you have a win-win either way. It's just what's your long-term commitment and what are you looking to do?
Well, here's the thing, guys. The good thing is there's data out there. So we could always look at the data. And you could be very hyper focused on the areas. What has it done in the last 10 years, 15, 20? It gives you a general idea. Everything we're going through right now is just weathering the storm. You know, just like we have 4 types of weather, right? It happens in an industry too. We also have to weather some storms. And you know what? We've been dealing with an excellent no rain, no thunderstorm real estate storm for many years.
Quite a while,
And so, you know, things have to balance out. They have to adjust. If we continue to have prices of homes continue to go up like that, really, and incomes are not going up, right? There is just no affordability. So something has to give. You know, something has to give. And so going back to this, you know, the consumer debt with credit cards, you know, again, it's inflation. The consumers paying more for foods and goods and services, and therefore they're charging it, you know, and so that's why we're continuing. The craziest thing is we haven't seen such a high debt since the New York Fed began tracking this back in 1999. You know, so that's a long time for us to be able to see this.
It's pretty unprecedented, and it's not going to get solved easily, I don't think.
No,
but it is. What am I trying to say? It's a symptom. It's a symptom of the problem. It's more of a symptom of the real problem underneath that. But
and then access to credit too, guys. Remember,
it's changing.
It's very well. It was so easy.
Right.
Now it's going to start getting kind of tapered back.
Even with the HELOCs in a couple of months, it's probably going to be a little bit more difficult to get one.
Absolutely. You know, on the good note, the good thing is delinquency rates for people paying consumer credit is really low.
Yeah, I did see that.
You know, so it's really, really low, which is great. That means people are working, people are still being able to pay, so it's not a bad thing.
And that's what I think is happening, that people are still working, they're still getting paid, so therefore they're like, hey, it's getting more expensive, but hey, I'm able to weather the storm, so hey, I guess everything will be good once it gets fixed, right, Fed?
Yeah, relative. It's relative.
I'll just keep spending like you guys.
It's relative and proportional.
Right, Uncle?
Pow, pow, pow. Yeah.
Hey, you got any more of those, printing machines out there?
Mi tío. Yeah.